Hello, guys. Welcome to Traders Talk. And today is Tuesday again, and we are here to talk about the stock market. Yeah, and for those who have just joined us, welcome. And if you're first time, my name is Ming Hon, and I'm here to actually talk about the stock market and how has the stock market been going for the last week. Okay, and if you have been following us, of course, week on week, we cover a lot of things, and of course, what we have actually mentioned last week, we have actually really seen that happening, and of course, for those who has been what is that listening tightly, I hope that you did not got scared by the market last week. Yeah. Okay, so the market yesterday, let's go through the market first, and of course, after that we will actually go through um, some example of what is that some trainings, and these trainings we actually cover will actually mainly be on trading the stock market using options. Yeah, so we will actually do some training on options, and of course, we will apply some strategies. We will apply some strategies that is actually applicable to some of the stocks right now, and we'll also show you how you can actually review these trades, and of course learn from there. Yeah, so these are always not trade recommendations, but mainly for learning purposes, so that you can actually learn and then test and apply into your trading strategies. Yeah, so let's start here. Okay, let's look at the markets. Let's see. Just a second. Okay. All right. So if you can see the screen, let me know that it's okay. You can actually see the screen. And okay, this is the, let me see. Yeah, this is the S&P 500. Yeah, this is the S&P 500. Yeah, just let me get this out here. Oops. All right, great. Let me put it on the handphone also. Okay, this is the S&P. Yesterday, we actually closed down by how much? Down, slightly down, uh, down by about only, no, it's actually up by 12 points yesterday. Yeah, but it's actually showing it's red candle. Yeah, red candle. Of course, I think what happened yesterday was the in the earlier part, the market has actually rallied up, right? Rallied up, but the market has actually sold down later the day. Let's look at the price action yesterday. Maybe we actually go to the 30 minutes chart to see what happened during yesterday's trade. Okay. So this is yesterday. Yeah, we opened up, right? You see, we opened actually gap up from Friday close. Yeah, Friday close, we actually gap up, and then what happened was the market sold down very quickly after about close to 1.5 hours. Yeah, after 1.5 hours, the market actually sold down and then made some recoveries. Yeah, made some recoveries, but at the end, it also just closed slightly above the opening price. Okay, and if you have actually followed us last week traders talk, right? We actually did mention about the current price action of the S&P 500 and the general market. Yeah. So at the moment, this is actually the price action for actually most of the stocks out there. Most of the stocks out there, you can actually see that their prices has actually made a double bottom here. Yeah, a double bottom here. Okay. And then, of course, it actually went rallied up very strongly the week before, not last week, but the week before. Yeah, the week before. And of course, last week, it was actually just trading sideways here. It was just trading sideways here for practically the whole of the week. The whole of the week, it was just trading sideways. And there were a couple of times they actually tried to go further. Of course, this was Monday, Tuesday, Wednesday, Thursday, Friday. Okay, so of course, this was actually Monday, right? Monday, Tuesday, Wednesday. Okay, this was actually Monday. Monday it actually came down. Tuesday it actually came down, and on Wednesday it actually tried to rally up. Sorry, this is Thursday. This is Monday itself. Monday it rallied strongly. Then on Tuesday it came down. Wednesday it came down. On Thursday it rallied up very strongly. Okay, Thursday it rallied up very strongly. But on Friday itself it came down, and this was actually the yesterday's candle, which does not show a very positive sign. Does not show a very positive sign because this is a bearish candle. So what we spoke about last week. What we spoke about last week was this. Okay, we said that the market has actually rallied strongly and went above this W neckline here, and this is actually a bullish momentum. But we caution the traders, and also the listeners that most likely there will be a pullback after a strong week of rally. Okay, and once the stock actually pulls back, right, what we actually want to see is actually the stock comes back down. Let me enlarge this. And why is my pen still crooked? Okay, so what I said is it will actually come back down. Let me choose another color. Okay, it will actually come back down and retest this neckline here. And what we want to see is we want to actually see a bullish or bearish candle. And that if it is that bullish or bearish candle would actually indicate give us an indication or a clue where the market would actually want to go. Okay, but of course, if you look at that it did came down on Wednesday. And of course, this candle to me is actually neither bullish or bearish, but of course it actually closed above the neckline here. Okay, still positive. It did not close below, but it actually closed above, indicating, of course, there is still a slight chance that it will actually go up. Of course, on the following day, it did went up. But it actually once again, it hit some form of resistance at this level, and it sold down again. Yeah. So and we did mention also last week that in such environment, right, most likely the market is actually going to trade sideways. It's actually going to trade sideways. And of course, during traders talk last week, we also gave some trainings that on how you can actually benefit from stocks that are actually moving sideways. Yeah, moving sideways. How you can actually benefit from there by using neutral strategies. Like iron condor. Yeah, and this okay, like iron condor. Yeah. Okay, so iron condor, of course, is a neutral strategy which comprise of what is that? bull put spread and also a bear call spread, yeah. And we actually want the stock to actually move within a range. And the example which we actually shown last week was Microsoft, right? And of course, we subsequent to the training, we look at the condition, and of course, we also put in iron condor trade into on Microsoft, and of course, the trade so far went on quite well with about 7 or 8% up since last week. And of course, if the trade continue, if the stock continue to move sideways, yeah, this was actually Microsoft, right? And of course, if the stock continue to move sideways, we would be fine, and we are not worried anything about the trade. As long as it moves within a band. And of course, Microsoft itself, I think what happened on last Thursday is that it gave some form of very negative news that it is actually suffering from foreign exchange losses, and post announcement about that, the stock actually dropped about 10 plus. It actually dropped immediately about $10 went down, yeah. And of course, I think at the end of the day, at the end of that day, Microsoft closed at +2, yeah, +2. So as I said, I mean, volatility is actually quite normal nowadays. Stocks can actually go up and go down by a lot within the same day. Yeah. So of course, if you are trading directional, then it will be also quite tough, because if we thought it will go down, then subsequently it reversed, it went up. Yeah. So neutral strategies are one way where we can actually tackle this form of volatility. Yeah. So coming back to SPX, where do we see the SPX in the current week, and what we need to actually watch out for? Yeah. So if you look at SPX here, of course, yesterday it actually closed down, and today I think it is also not too good on the futures this morning, and I think futures is currently down. Just let me check. Futures is actually currently also down, yeah, and Nasdaq futures was down by about 100 over points. Let me just check. Yeah, Nasdaq futures is down about 130 or 140 points, and the E-mini S&P futures is also down about 30 over points. Yeah, and of course, this week, what do we expect? On Friday, there is actually the CPI announcement on Friday, and because of the CPI announcement, the market may continue to actually trade cautiously until Friday. So trading might be very thin, and of course, when trading is thin, then the volatility can also be high within the. I mean, it might bounce around. It might bounce around within the week until the CPI comes out, and the market looks at whether to work it up or work it down. Okay, so of course, if the market is actually going up, right, then there is some level of resistance which we would actually expect, which is actually at, let me plug in my wire, which we would actually expect at around 4,200. Yeah, about at this 4,300 level. Yeah, we would actually expect some form of resistance here. Yeah, around this level. Yeah, and of course, once we actually hit this, we need to breach. I mean, because we have been down by so much, right? There is actually a lot of levels for us to for the market to actually breach in order to go back higher. Yeah. but in the current environment like this, I would not expect it to be a one-way up. It would actually, how to say, rally up a bit, then move sideways a bit, rally up a bit, move sideways a bit, or even actually come down, or even more. You see, it depends on what catalyst is there in the market. There's actually few which is still lingering. Of course, as I said, the war is one. Yeah, oil price has shot up higher again. And of course, the other ones are the general economic situation in the US. So some of these data coming out would be a feast, for the news, the market makers to actually eat on. Yeah, of course, if bad news comes, they can actually take on the bad news to actually push the market down. And of course, if good news comes, they can actually take that news to actually push the market up. So it can also be one day good news, one day bad news. Yeah. Okay. So that's the market situation right now. And of course, even for us, we would actually tend to be still cautious into a huge directional trade. And if we trade directional, that will only be based on short-term directional trade, which is actually what is that? A day or two, a day or two kind. But of course, there is also, what is that? This is Nasdaq. Nasdaq is actually more or less the same. Nasdaq is also more or less the same. It is actually going sideways here. Yeah. And of course, the next level for them to actually breach is around this 13,200 level, and of course, the bottom here of about 11,700, right? 11,700, between 11,000, 11,700 and 11,006. Yeah, this is actually forming a support for the time being. Yeah, support for the time being. So range between 11,006 up to 13,200. Yeah. And of course, again, this kind of structures would actually be good to actually trade on iron condor, using iron condor. Of course, and this NDX, you can actually just use QQQ if you actually want to trade a neutral strategy using iron condor. Yeah. And of course, today I actually also wanted to talk to you guys on Amazon, right? Okay, so we actually spoken on Amazon. I think in a couple of shows earlier, that Amazon is actually doing a stock split, right? Which stock split has actually happened yesterday. Amazon done the stock split, and the price was about what's the price of this stock split? The stock split was open at 1247. No, open 125, 125, 125, 125. Close. I think it was around 121. Let me see. This is Amazon yesterday price, open at 125.5. Cannot be closed at 124. Okay, 125.5 actually is the split there. But what happened yesterday was on open, that means from the split price, the last Saturday closing, right? Last Saturday, it actually gap up from last Saturday closing. So the price would be this price of 122.35 is the split price. 122.35 is the split price. And then yesterday, once the market has actually opened, Amazon has actually added another plus $4, $4 went up by $4 to $5. Yeah, of course, when the market sell off subsequent to that, the price has actually dropped, and even with that, it also plus another $2 yesterday. Yeah. So what we did say in Amazon was that when companies do stock split, right? When companies do stock split, uh, the split does not change the anything fundamental on the stock. Yeah. And of course, just like having a pizza, right? If you have a pizza and if you have one round pizza, and if you cut it to 8 slices, right? 8 slices, 8 slices, these this pizza will not become bigger after you have actually cut it. So each slice would be the same size, and of course, if you add up the full all the 8 slices, it will become the same. Yeah. So stock split is the same situation. Is that how to say, it will not change the fundamental of the stock. But of course, what happened is that when it is actually a really also some form of view or mentality of people, right? And of course, if you look at having a pizza, one full pizza, and if you buy one full pizza, you might pay, say, how much is the pizza? $15. Yeah, you might actually pay $15 for one full pizza, right? One full pizza. And of course, if you split the pizza and you actually sell single slices, right? You actually sell 8 slices separately. 8 slices separately. Each slice you might sell it for say $3 each slice. Yeah, $3 each slice. You might sell it for $3. So of course, 3 times 8, you get to actually collect $24. Yeah, $24 is correct. My math is correct, right? Okay, you get to collect $24 by splitting this, but essentially it's the same. If you buy one whole thing, you pay 15, and if you split it, you might be able to actually sell it for more. Yeah. So again, the mentality for stock splits in the stock market is actually similar to what situation which I've actually shown you. As 100 stocks, right? 100 stocks, which is worth 22 or 23,000 before the stock split, right? Now you actually split it into 20 shares, 20 from 100. You actually split it, sorry, from one stock you split it into 20 from one share you split it into 20. For example, if you have 100 shares, then you actually split it into how many 200, right? 200. So it makes the number bigger. Yeah, you have how to say, more like more pizza to actually eat, right? The same, the stock would have more numbers, so it makes it more liquid in the market. That's one thing which actually happens. Yeah, it makes the share more liquid, because previously you have to pay maybe $2,200 to actually buy one, right? One, you need to pay $2,200, and of course, after the stock split, right? You need to only pay about 100 here. I just use today's price. You need to only pay about $124. Yeah. So this makes it affordable, right? So if people cannot buy one share for $2,200, and today you can actually buy one share for $124. Yeah, $124, you can actually buy one share. So of course, it gives people the illusion Amazon is cheap. Amazon is cheap. In fact, there is no change in the value. It is just $2,200 divided by 20, and you get that smaller figure here. Yeah, but it gives the impression it's lower, then more people will actually come in and buy Amazon. And of course, with higher liquidity, and if people actually chase the stocks, right, then of course the price can actually move up. That's why even before the stock split, right, people has already started to buy into Amazon, and you can see that Amazon price has been going up quite high, sometimes above $100 a day the week before the stock split. Yeah, the week before the stock split. Okay, so that was actually Amazon, and of course the same thing is happening on this Google, right? Google, yeah, the same thing is actually happening on Google, and Google stock split is actually coming on the 15th of July, if not mistaken. Yeah, 15th of July. So basically, you would have about a month lah, a month, slightly above a month lah, before the split comes into action. And of course, the 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 situation may be yeah the same as Amazon, that pre-split the stock price rallies, and of course post-split the stock price uh, will also go up. So currently, Google is actually trading at $2,300. Yeah. So of course, if you divide it by 20, then you have a stock of also about 100. I mean, close to $120 lah, or slightly lower around there. Yeah. So you have actually also a very low price stocks as compared to the previous. Only in the price, the number has already is split from one share is split into 20. So if you hold 20 Google shares post split, is equivalent to you holding one share pre split. Yeah, but it gives the illusion that the price is cheap and liquidity will actually also increase post split, and as a result will give how to say, will give more value for money implied value, more value for money on the stock, and hopefully that will spur the stock to actually move up higher. Okay, so Amazon is one, Google is one, and of course in the past uh, similar situations has also happened to stocks like Apple when they did the stock split. I think it was last year, if not mistaken. Amazon did it, Tesla did it, and also Nvidia also did stock split. Yeah, so more or less those companies had similar situations in terms of the higher perceived value. Yeah, how long it will stay up, of course, no one can predict. I mean, of course, if you look at shares like Nvidia, I mean, it has rallied up, and then of course now it has actually came down. So we like as traders, right? I mean, we trade on opportunities, right? We trade on opportunities, and of course, this time round, this is actually one opportunity which we can actually use to trade on this idea. Yeah, so how can we actually capitalize on this? We can actually use some structures. We can actually use some option structures to structure out a trade, and of course I will go through with you here what type of structure which we can consider. Yeah, we can actually consider. Let me take here. Okay. Okay. Okay, so what we can actually do, I mean, on Google, right? On Google, is to actually, of course, you can buy a call. You can actually buy a call and wait for the price to go up. But of course, to buy a call for Google, if you do at the money call here, if you do at the money call here, the price for Google would actually be $127. So you need to actually pay just for a slightly above a month expiry, you need to actually pay $127, which is $12,700 to buy a call. What if Google price go down or the market go down? Then you will actually lose $12,700 within less than 2 months. Yeah, so that is actually very expensive play to actually trade on this. Yeah, trade on this. Then of course, to make it cheaper and to have a directional play, we can actually always go on a bull call spread. Yeah, a bull call spread. Okay, what is actually a bull call spread? Is basically just a vertical spread where we actually buy a call. Let me just put it here. It is actually what here. Let me do. Okay, vertical call is basically what we have. We have a buy a call, okay, at X price, and then at the same time we sell a call at the higher of X price. Yeah, higher of X price, and this higher of X price is the price which we target the stock to land on or move to at the end of the expiry period of the option. Yeah, for example, for our Google example here, we current trading price is 1222336, right? 2336. So on 15th of July, where Google will actually do their stock split, right? So where will this stock price land? Yeah, where will this stock price land? If you feel that it will land at $2,500, then you can actually do a spread buying 2340, buying a call, and then you sell a call at 2,500. Yeah, you can actually do that. But of course, this call, because it is actually very far, the width is actually very far, then that will also be very expensive trade for you. Very expensive trade for you. Yeah, and of course, if it doesn't move to $2,500, it actually goes how to say, below 2,340. Of course you will lose money. Yeah, of course, if it moves in between, depending on which place in between, you might win or you might also lose. Yeah, so this spread is actually quite wide. So we also want to do a very safe trade, where your chances to actually win is higher, and also you don't need to actually wait until end of the expiry to gain the benefit. So of course, the easiest and fastest way is to actually do a very tight spread, which is basically just a $5 width here, $5 wide here. If you look here, it is just a $5 wide spread where we actually do at the money means more or less at the strike closest to the current stock price, which is 2340. This is the at the money, and then we just sell one strike above. Okay, generally for this type of spreads, you will be able to actually do a risk of return of 1-to-1. Yeah, 1-to-1. Generally, like, you can actually do 1-to-1. If you move the strike further up, then of course the risk on reward can actually be more than 1-to-1. Yeah, but if you do this on a one strike, you need to actually get at least on a 1-to-1. And of course, with this spread, you can actually you need to actually pay $2.45 for this spread. Okay, so what is good about this? If you do it, let's say timing wise, you can do it now, or you can actually also do it later. Yeah, you can actually do it later, because the spread is tight. Yeah, the spread is tight. As long as the price momentum runs above the $5, because Google you look at Google, one day it can go up 30, 40, 50, 60 or $70. So for it to go up more than $5, it is actually quite very possible lah. Of course, it can go the other way lah. It can go the other way. It's also quite possible. So the only thing which we need to ensure when we actually trade this is that the trade direction has to be consistently there. That means the upward direction of Google from the time you actually enter the trade will have to actually continue to be bullish and going up. And of course, best is always above your strike prices. Yeah. So if enter now, then if the momentum continues, you don't have to worry about the trade because the trade would be positive quite fast. Yeah. And here, let's put it here. The prices, right? Currently is 2336. So current price is 2336. Yeah. And if you do here would be 240, 245. Yeah. So this is actually 240, $2,400, 2340. Sorry, 2340. So bad writing. Okay, let me put it away. 2340 and 2345. Yeah. Okay. So this is the current structure. And of course, if say Google, right? If Google actually goes up today by $10, say plus 10, it goes up to 2346. 2346. 2346. Yeah. So once it goes up by 2346, is already above your strike here. Above your strike here, then the trade will actually turn positive. And of course, let's say over the days, it continues to actually go up to 244, 2446. It is actually another $10 above. But of course, you will not get the max profit for this trade, even though it has actually gone above, because your expiry, which we put in here, is actually 22nd of July. Yeah, 22nd of July, because we want to actually do the expiry after the stock split has happened. Don't do it before because you need to actually do it after to get the momentum impression of cheaper stock, people buy in, and stock price move further up. Yeah. So you need to actually choose the date which is actually after the stock split. 1 week after the stock split is fine. Yeah. So you do this, and of course, in time, in time, it will be positive if it move into that direction. But of course, even if it rallies up by a lot, if it rallies up by a lot, even though the what is that, the expiry is still far away, yeah, is still far away, you can also get very high profit of maybe about 60% to 70%. You can also generate even if it is not till this expiry. But of course, the stock price have to actually move further from your upper strike, your short strike, by a lot. Yeah. Example, if it goes to say $2,700, then of course you don't need to even wait for the Google stock to expire or close to expiry to close the trade. You can even close it earlier, yeah, so that you can actually pocket in the profits. Yeah. So this is the cheap way to actually enter a trade based on this corporate transaction which Google is going to do. Yeah. So the similar structure of this we have done on Amazon. We have done on Amazon similar structure, and of course, the trade is also positive. Positive, same kind of thing, same methodology we applied on Amazon. Of course, the trade is positive, and of course, if the expiry will be this week. In fact, that trade we open it only last about mid of last week, maybe about Wednesday. I think it was Wednesday. We opened that trade just on Wednesday itself, and we didn't even go to the earlier rally which has happened. And of course, because Google, you still have a long time some more, right? Then of course, you if it rallies from now, then of course you can have further what is that? You can ride the up momentum lah, when this happens lah. Of course, if market goes down, then everything everything go away, right? Everything can go down. But of course, if the market continue to move sideways, it would actually be quite possible for Google to continue its bullish momentum during this one month. Yeah. Okay. So this is the trade, and how many of you would like to get insurance? That means get insurance, or how many of you, maybe not insurance, how many of you would like to eat free pizza? Okay, that means you eat that pizza and you don't need to pay one. You know, like you go to Pizza Hut, then sometimes they give you coupon, right? They give you coupon, then you can actually claim the pizza for free. How many of you would like to actually eat free pizza? If you like to eat free pizza, give me a thumbs up or love. Then I will share with you how do we actually eat this Google free pizza. Yeah. Oh, no love, no thumbs up. So so I'm not going to share with you how to actually get a free pizza with structure out a free pizza for Google. Not interested, huh? Okay. Yeah. Okay, let's see who is interested. Okay. So I will share with you, like, I mean, don't pull your leg lah. Okay. So one thing is, of course, as I said, things can be uncertain. And of course, when things are uncertain, right, we would also, all the love and the thumbs up is coming. So when things are uncertain, we would also want to actually get some form of insurance for the trade. Okay, some form of insurance for the trade. Because when you go on a directional bullish trade, right, what happens is that if it doesn't go your way, you will actually lose the debit which you actually pay for the trade. And of course, just now that trade is costing you $2.35. Okay, you would not want to actually lose $2.35 on a trade. Okay, so how do you actually put a bit of insurance on the trade? On the trade, yeah. So in options trading, right, it is actually always possible for you to actually buy an insurance. Yeah, of course, when you buy an insurance, there's also some form of risk associated to it. But we need to actually know how to actually manage the risk and actually know how to actually structure it out. Okay, and in order to actually do this, right, we firstly actually look at Google stock price, right? Where is the stock price? Okay. We actually look at Google stock price here. Okay. You guys see the screen? See the screen? Okay, good. So if you actually look at the Google stock price here, it's actually currently trading at here, right? 2310. Yeah, that's why you see today it's going down by $6. Yeah, it's going down by $6. In fact, I expect the market to actually come down. And if you are doing this trade, I do not. I mean, how to say? If you are evaluating, yeah, I do not recommend for you to actually how to say, enter so fast. Wait for the market to retrace. Because you have about six weeks to evaluate this trade. About 6 weeks to evaluate this trade. And as I said, because your spread is only $5 wide, right? There is actually no rush for you to actually jump into the trade. There's actually no rush for you to actually jump into the trade. Look for a right opportunity. Look for a price where Google actually retraces first. And once it retraces, you actually take the opportunity to actually see that if there is actually chance to actually get into the trade cheap, at lower strike price. Yeah, at lower strike price. Okay, so going back to insurance. Yeah, going back to insurance. If you look at normally in options trading, insurance comes in collecting premiums. Okay, but when we say collecting premiums, means that it involves selling of options. Okay, it involves selling of options. Earlier, just now, that spread is buying of options. Yeah, and of course, there is one leg which is selling of options on the higher strike price, the higher strike price of 2345, right? That higher strike price involves selling. And on top of that, if you want to actually get more insurance, you can actually also structure out that debit trade with a credit spread, okay, with a credit spread. Because we are actually directional, right? We're actually directional. We actually want the stock to go up. So you do a credit spread, which is also directional in nature, which is what we call a bull put spread. A bull put spread. Yeah, a bull put spread is basically how to say, is basically selling of a put, of a put. Yes, you sell a put at X price, and then at the same time you buy a put. Yeah, I buy a put at a price lower than X, yeah. So when you actually form a put spread, you actually want the share price to actually go up. Yeah, and when you do this, you actually get to collect premium. Okay, you actually get to collect premium. So that premium which you actually collect, right? You use that premium to actually finance the a debit trade, which is the bull call spread, which you do, actually do. Yeah. And at what price you actually want to do that selling of the oops, I share again. At what price you actually want to do the selling of the put spread, right? The put spread, right, is you look at this price of Google, right? Okay, so if you look at the price of Google, right, at the moment, I mean, based on the current structure, you can see that the lowest it has actually went is about 2,000 points here, right? 2,000 points here. This was actually the lowest. So you form to say that, okay, this is the lowest price, and at the moment this is the bottom here. And if you can see at whether you can actually structure out any put spreads at this level, 2,000, here is about 2050. You can actually see whether you can actually do a put spread at this level to be safe, okay. And if you go to the options chain, let me see if I have actually got it. If you go to the options chain, let me see what price I actually picked just now, right? Okay, I actually picked a price. I'm only showing you the concept here. Then later you need, when you want to actually evaluate the structure for learning purposes, right? You actually need to go back to the price at that point in time and see whether you can actually pick it here. Something wrong here. What's the problem here? Wait. Okay, maybe I don't share this. Maybe I share this. Okay, so just now was 2050, right? Okay, so this is Google, right? You can see Google, right? Okay, so this is Google. You go to 22nd of July, 22nd of July. Let it load. Okay, So you go to 22nd of July options chain, right? Just now the debit spread was here. You go to 22nd of July and actually run down to more or less delta, I would say delta 20 lah. Yeah, delta 20. You can actually check here. Just now was actually 2040, right? Let's clear this. 2040 and this is 2020. Okay, so this you got to be careful because this is actually what is that? A $10 sorry, a $20 white, a $20 white spread, a $20 white spread. So a $20 white spread is actually too wide for the risk to be taken because your risk is $1,700 here. So you actually got to see. I think Google has not, how to say, Google the strike price normally you can actually go here. Yeah, I think at the level where you can actually get a $5 width, $5 width is here 2215, right? Yeah, so this is still a $5 width before it actually goes on 20. This is the this is no, this is 221. This is even this is $15 width. Here 2200 Yeah, so this is actually $5 width, $5 width. And for $5 width, here the premium you get is $1.60, $1.60. And the max loss for this credit spread is 340. So you collect $1.60, and you need to actually you collect $1.60 lah. So as long as the strike price don't go below $2,200, $2,220, then you will actually profit from this trade. Earlier, the lowest level was 2040, right? 2040. So basically, you are actually taking about $150 risk before to the lower strike lah, lower strike. Yeah, but even that, this basically gives you a 60% probability, 60% probability that it won't hit this this level. Yeah, won't hit this level. You can also wait. You can also wait later lah. I mean, because when it is actually nearer to the expiration, because this is actually still far. When it's actually nearer, sometimes the spread width also reduces at certain timing. You can actually get a different $5 width, or you can also go on $10 width if you actually want to check the strikes again. Yeah. Okay, so let's put a scenario where we actually get 160 for a $5 credit spread with 60% probability, yeah, of win. And you actually structure it out with the debit spread earlier, which you actually did of 2340 and 2345. This is the one, right? Okay, so for this this spread, right, from paying $2.45, right, $2.45, with that credit spread financing and giving you some form of insurance, you will actually need to pay 85 cents only for this trade. You will only get to pay 85 cents, and your buying power effect here is $5 585. So this is actually your max loss lah. If you lose, if the price goes all the way below the put spread, then you will lose 585. But of course, we won't let it go down all the way. In case the direction is against us, then of course we can actually close the trade or exit the trade with a lesser loss. But chances are, with the stock split coming in and all, the higher chance for the stock to actually rally is actually higher. So the chances for this trade to be actually positive, I would say, if it happens based on history, like Google, like Amazon, Tesla, Nvidia, and all, then there is actually a high probability for this to move in our direction. Yeah. So it gives you two profits, two ways. One is the insurance will actually buy you time in case it doesn't move quick enough. Then that insurance will actually cover for the decay in the value decay in the spread, in the debit spread. And the other one is, of course, it provides you with financing. It provides you with financing. As compared to just doing a straight call, credit spread can be structured with calls to reduce the entry price. Yeah, and of course, even the bull call spread, we already have a selling of a higher strike call to finance the call which we actually buying. Yeah. So this is how we do this this trade. Yeah, and of course, if you look at the analysis, this is the thing. I mean, we need the stock price to actually go up to actually benefit in the trade. Yeah, of course, the faster it goes up, the faster you gain for the debit spread, and also at the same time you will actually earn the profits coming out from the credit put spread, credit bull put spread. All right, so this is what we wanted to share with you, an explanation on trade structure based on corporate actions, which is actually happening, and you can actually use that to structure out some trades. I mean, it can be Google, it can be anyone, as long as you have the same bullish thesis on the stock, you can actually structure out trades using this kind of option structure. Yeah. All right. So that's all from my side this week, and hopefully we can actually get a good market. And for me, neutral is fine for the time being. Yeah, I don't need to be so bullish, because we have actually put in quite a number of neutral line condors for the index, for the indexes, even for trades like Microsoft, Facebook, even Visa. We have actually structured out neutral trades, and as long as the market continues to bounce here and bounce there within range, then of course we will be able to actually profit from the time decay. Yep. So great to see you guys here, Facebook user Chun Kiat, nice to see you again. I hope the market is doing good to you. Yeah, it's not a good how to say, it's not a good time for selling put nowadays. Yeah, so so I've long how to say, not so many puts nowadays. Yeah, and of course it will be very short the directional trades. Yeah, Wani, time to buy Tesla. Okay, I sold how to say, I sold Tesla last Friday. Yeah, I sold Tesla last Friday. How to say, on a temporary how to say, temporary because last Friday it went down, right? So just a short trade. Thursday, I think Wednesday or Thursday, did Tesla, and then Friday when the market sold off, then I sold the position. I think yes, Tesla on Monday, it has actually gone up, right? Tesla has actually gone up. I would say is again it's a difficult market. When you say is it time to buy Tesla, I cannot say yes or no. Okay, I cannot say yes or no, because you see, even for Tesla stock price, right? This is Tesla, right? It is actually how to say, moving up and down along with the market, and especially right now for Tesla, when they have this Twitter deal behind, right? Twitter deal behind, it actually also influences Tesla's stock price. Like yesterday itself, Tesla went. I think Tesla went up yesterday, right? Tesla went up yesterday, and if you look at Twitter, right? Twitter should come down yesterday. Twitter also went up. Twitter came down yesterday by 60 cents, and Tesla went up. So the thing with this thing is actually trading in inverse. Yeah, it's trading in inverse because of the transaction. And if that transaction goes through, Tesla price may likely go down. Yeah, because the market does not like them to actually do the Tesla deal. Yeah. So of course, if you talk about whether again it is short trades. If you actually do short trades, I think it's okay if it comes down again. Testing certain levels, you can actually do short trades, but hopefully when you are in the trade, the deal on Tesla and what is that? Twitter does not go through. Otherwise, you can actually shoot down some more. Is it? Yeah. But of course, the momentum for Tesla right now is going down. Since the deal was announced, right, it is actually all going down. And at this level here, it is actually having some form of resistance. Yep, some form of resistance at the level of about $760 here. Is actually having some form of resistance here. Yeah. Okay. All right. So okay. Thanks for becoming a good guest. Lot of love and lot of likes, and of course, I hope you guys will be able to also help me out a bit, share out our traders talk, and of course, the more people who come on board, then of course, I will actually share much much more, and make this show more interesting for you guys. Yeah. And also hope that everybody can actually get a good takeaway from our show every week, and to become better traders in the market. Yeah. So catch you guys next week. Have a safe trading week, and bye bye. See you.